All right, guys, welcome back to another video. In this one, we're going to talk about non-accredited versus accredited investors. Okay, you may have heard these terms thrown around like, hey, you can only invest if you're an accredited investor. If you've ever wondered what those mean and what the requirements are, that's what this video is for. Now, there are a number of different investments, and generally speaking, private funds, but also public funds that are investment types that you can invest in. So hedge funds, private equity funds, real estate funds, venture capital funds. These are different investment vehicles that were created where people can invest their money and they go invest in a certain thing, right? Hedge funds traditionally are in the public markets, right? Like stocks, bonds. They can get into foreign exchange and currencies, and they can get into all types of products, but generally they're available on the public markets, okay? Private equity funds generally are buying established companies and flipping companies, essentially, right? They're buying established companies and growing them and selling them, or some deviation of that. Real estate funds, self-explanatory. There's a lot of different structures for this, but generally they go acquire real estate. And then venture capital funds invest in early stage startup companies. Okay. So VC funds are probably the most talked about because they're all the rage, right? All the startups that we see raising hundreds of $1 million in each round, and hitting unicorn status, being valued at $1 billion. They're all raising funds from these venture capital firms that are going out and raising and say, hey, I want to be in early on that. So it's very much a part of our culture and about the hype of startups and the ecosystem. Venture capital is really well known. The other ones, maybe not so much, or maybe you haven't heard about them as much in the press. Okay. There's a lot of other different variations of funds that can do all types of things, but generally speaking, a lot of these funds only are allowed to let accredited investors invest in these. Okay. Now, the purpose, so the SEC, the Securities Exchange Commission, they are the entity that kind of governs anything regarded to securities and investments and offerings and that type of thing. They wanted to protect unsophisticated investors from investing in something they don't understand or really can't afford to lose what they're investing, okay? Because it might be too risky. So that was the intent. Now, whether or not that's accomplished is a story for another day, but generally speaking, you can meet it on a net worth requirement, on an income requirement, or others. So we're going to talk about those. What these requirements end up doing, though, is allowing only already wealthy people to invest in a lot of these types of investments and growing the wealth gap, essentially. Non-accredited investors are stuck with more limited options and don't have access to a lot of these things that might grow their money quicker or faster or more efficiently. I say may because not all of these private funds work out. There is significant risk in these, but essentially that's what's happened. So let's talk through what the requirements are and if you meet those requirements or if you don't. So there's number one, to be qualified as an accredited investor, you need to meet the income test. Okay. That means that you have $200,000 of annual income or $300,000 if you're married, right? Of joint income. You must have had that income for at least the last 2 years. And you have to have the expectation of receiving that same income in the current year. Okay. If you do, then you meet the test of an accredited investor and you can invest. The next is the net worth test. If you have a net worth of $1 million or more, excluding your primary residence, then you also qualify as an accredited investor. They recently amended these requirements to broaden the definition and include more people to investment professionals that have certain certifications or designations. So if you are an individual that is registered and you hold the Series 7, 65, or 82 license, those are securities licenses, and you hold them, are currently registered and in good standing, then you are considered an accredited investor as well. They also broaden the definition to include individuals who are knowledgeable employees of the private fund that they're investing in. So if you are working with, if you're an employee of a fund, by virtue of you being an employee, a knowledgeable employee of the fund, you're able to invest into that fund as well, even if you don't meet the other requirements. And then certain entities, trusts, or certain business entities, that have assets of $5 million or more that aren't formed specifically to invest in that investment, right? So they were pre-existing or they were already established, then they also can qualify, okay? So if you get a bunch of non-accredited investors to pool their money and create an entity that does things and has more than $5 million of assets, then you could, invest in these types of funds that, you'd be qualified as an accredited investor at that point as well, okay? So what's interesting about these is, generally speaking, you don't have, sometimes depends on the regulation, okay, but you don't have to prove that you're an accredited investor or not. The burden is on the issuer of the security. So the fund manager or whatever, they're the ones ultimately that could get in trouble by allowing a non-accredited investor into an investment that is specifically for accredited investors only. And so depending on a number of exemptions they use, the Investment Company Act and Securities Act are very complicated. But usually the issuer of the security, right, the fund manager or what have you, they will verify accreditation status or ask that you prove it in order to let you in, okay? So kind of the burden is on them. So technically you could probably lie to get in, but you could also screw up everything in that fund if it's found out, and a lot of problems could happen, and problems could happen to the issuer of the security. So you don't want to lie to get around this, but those are the requirements. Now, there are certain investments that only allow qualified clients to invest, okay? Being accredited is not enough, okay? Certain fund structures and so forth require you to be a qualified client, which means you need to have a net worth of at least $2.2 million, excluding primary residence. Then you're a qualified client. You can get access to additional types of funds and structures in that way, okay? So those, in really basic terms, those are some of the differences. There's a few other nuances in there. But if you ever see a fund or an investment that says, hey, accredited investors only, or hey, we accept up to 35 non-accredited investors, for example, that's what that means. And there's a lot of fund types out there, a lot of really interesting private investments. And so it's important to understand whether you qualify or not, or what you need to do in order to qualify to then invest in these types of offerings. All right, that wraps up this video. We're going to see you guys in the next one.
Keep learning, keep growing, and take control of your financial future.